Welcome to the deep dive. We're digging into your source material today. It's a really detailed look at advanced partnership tax concepts. Our mission, as always, is to unpack the most important ideas, the definitions, the rules, the stuff hidden inside. We want to give you a clearer picture of how partnerships really work for tax, especially around formation, basis, transactions, and distributions.
Absolutely. And it's definitely complex, but so important, especially because partnerships and LLCs taxed like partnerships are these flow-through entities.
Flow through, right. Meaning the partnership itself doesn't usually pay the tax.
Exactly. The income, losses, deductions, all that stuff gets figured out at the partnership level, but then it flows right through to the partner's individual returns.
Yeah.
So understanding these rules is just, it's crucial for partners to report everything correctly and manage their own investment basis.
Okay, let's jump right in then. Formation. The very beginning. How does a partnership actually start, tax-wise? What happens when partners throw assets or even services into the pot?
Well, the general rule, and this is really fundamental, is usually pretty simple. Contributing property in exchange for a partnership interest. Typically, no gain or loss recognized right then.
No gain or loss. So it's a non-taxable event.
For the most part, yes.
Mm.
It's a key feature. The idea is to make forming partnerships easier. Just combining assets shouldn't trigger immediate tax. That's deferred.
Okay, so let's say I have a building. Bought it ages ago for, say, $100,000. Now it's worth $300,000. I contribute that to a new partnership for my share. I
Yeah.
don't pay tax on that $200,000 increase in value right away.
Generally, that's exactly right. Your example one shows this clearly. Contributing land with a basis of $30K, but it's worth $50K. You recognize zero gain at that moment on the $20K appreciation.
Zero gain then. But the gain doesn't just disappear, right?
No, definitely not. It's deferred. The partnership essentially takes your old basis, that $30K in the example, and then there's this concept of built-in gain. We'll get more into that later, which basically makes sure that you, the contributor, eventually pay tax on that pre-contribution $20 gain when the partnership sells the land.
Okay, that makes sense. Deferred, not forgiven. Now, you mentioned getting a partnership interest back. Is that just like one standard thing? Or are there different types?
Good question. That's a really critical distinction. It's not just one thing. You can get a capital interest or a profits interest, or sometimes both.
Capital versus profits interest? What's the difference?
A capital interest gives you a right to a share of the partnership's net assets right now if it were to liquidate immediately. It's about the current value. A profits interest, though, that only gives you a right to a share of future profits or losses. Nothing based on today's asset value, just the upside or downside going forward.
I see. Current assets versus future potential. Does it matter what I contribute to get these different interests, like property versus my time and skills, my services?
Oh, absolutely. Huge difference. And this is where we hit a major exception to that no gain on contribution rule we started with.
An exception. Okay.
Yeah. Let's talk about profits interest for services. Say you're providing ongoing expertise, management, whatever, and you get a piece of the future profits for that, generally. You do not recognize income when you receive that profits interest.
No an income recognized. Why not?
Well, the thinking is it's a right to uncertain future profits. It doesn't have a measurable value today, and crucially, no liquidation value right when you get it. Your example 2 illustrates this zero income for getting a 20% profits interest, even if the partnership has valuable assets. How do you reliably value a maybe future profit? Tax law basically says, for this specific interest received for services, you don't try to tax it at formation.
Okay, so future profits interest for services, generally tax-free on receipt. What about the other one, the capital interest, if I get that for services?
That's completely different. Receiving a capital interest for services, that is taxable ordinary income to you right away.
Taxable. How much?
The amount is the fair market value or the liquidation value of that capital interest on the day you receive it. Example 3 shows this. Get a 20% capital interest when the partnership could liquidate for $80,000. Boom, you have $16,000 of ordinary income, 80K times 20%.
Wow, $16,000 of income just for getting the interest. Why the different treatment?
Because you've received a claim on the partnership's current assets, tangible value, in exchange for your services. It's almost like the partnership paid you $16,000 cash for your work, and you immediately contributed that cash back for your capital interest. That's how the tax logic sees it. And for the partnership, that $16,000 is a cost for your services. They either deduct it or capitalize it, depending on what the services were for.
Okay, so let me recap. Property and for an interest, usually tax-free. Just a profits interest for services, usually tax-free on receipt, but a capital interest for services. Taxable ordinary income right away. Got it. That's huge. Now, debt. This always complicates things. What if the property I contribute has a mortgage on it? Or the partnership takes out loans?
Yep, debt definitely adds another layer. And it can actually trigger a taxable gain even when you contribute property, breaking that general non-recognition rule.
How does that happen?
It happens if you contribute property subject to a liability, and the amount of that liability that gets effectively assumed by the other partners is more than your tax basis in the property you put in. That excess amount, the debt relief greater than your basis, is treated like taxable boot.
Right.
You recognize a gain equal to that
It's
excess.
taxable boot. Okay.
Yeah.
So it's like the other partners paid me cash by taking on my debt.
Kind of, yeah. It's like you received a cash payment equal to the debt shifted to them. And since that payment exceeds your investment, your basis in the property, you've got a realized gain that needs to be taxed now. This ties into a core principle mentioned in one of those past key boxes. Your basis can't start below zero. If the debt shift would make your basis negative, you recognize gain instead, which brings your basis back up to zero. And remember, you only count the portion of the liability assumed by the other partners for this calculation, not the whole debt.
Right. Only the part shifted to others. Okay, that makes sense. If I'm relieved of more debt than my investment cost, I've essentially cashed out some value. All right, this keeps bringing us back to basis. It sounds like the absolute cornerstone of partnership tax. Can you break down what basis really is here?
Absolutely. Basis is fundamentally your tax investment or your tax cost in something. In partnerships, we actually talk about two different kinds of basis, and it's super important to keep them straight.
Two kinds. Okay.
First, there's outside basis. That's your basis in your partnership interest. Think of it like your basis in stock if it were a corporation, representing your personal investment. But here's a huge difference. Your outside basis also includes your share of the partnership's debts. That's unique to partnerships and really important.
Okay, outside basis is my investment, including my share of debt. What's the second type?
The second type is inside basis. This is the partnership's basis in the assets it owns. So when you contribute property, the partnership's inside basis in that asset is usually your old basis. We call that a carryover basis. If the partnership buys an asset, its inside basis is the purchase price. So inside basis tracks the partnership's investment and its assets, while outside basis tracks your investment in the partnership.
Got it. Outside partner's view. Inside partnership's view. So how do I calculate my initial outside basis when I first join, or the partnership forms?
Okay, your starting outside basis calculation. It's basically adding up everything you put in, adjusted for debt. It starts with cash you contribute, plus the adjusted basis of any property you contribute, plus the fair market value of services if you got a capital interest for them because you already paid tax on that value. Then you subtract any of your liabilities on contributed property that are assumed by the other partners. And then crucially, you add your share of the partnership's overall liabilities existing after formation.
Okay, so contributions plus my share of partnership debt minus debt relief given to me by others, and it can't go below zero, right?
Yeah.
Excess debt relief triggers gain instead.
Exactly. If that calculation dips below zero because of the debt assumed by others exceeding your contributed basis, you recognize gain equal to that negative amount, and your starting basis becomes zero.
That part about adding my share of partnership liabilities seems really significant. It could really bump up my basis. How is that share determined? How is partnership debt allocated?
Yes. This is probably one of the trickiest parts. It depends entirely on the type of debt and the type of partner or owner involved.
Okay, type of debt, type of partner. Let's break it down.
First, recourse debt. This is debt where at least one partner has personal liability. If the partnership defaults, the creditor can come after that partner's personal assets, house, car, whatever. Recourse debt is allocated for basis purposes only to those partners who have that personal liability. Usually that means general partners. Limited partners or LLC members typically don't have personal liability, so they generally don't get allocated any recourse debt basis unless they personally guarantee the debt.
So if I'm just a limited partner, I don't get basis from recourse debt unless I specifically sign a guarantee.
Correct. Example 7 shows this. GP gets all the basis from a recourse loan, LP gets none, assuming no guarantee. Now, second type, non-recourse debt. This debt is typically secured by specific partnership property. The lender's only option on default is to take that property. They generally can't go after the partners personally. Non-recourse debt is allocated differently. It's allocated among all partners, including limited partners and LLC members, usually based on their profit-sharing ratios.
Ah, okay. So non-recourse debt does increase my basis even if I'm an LP or LLC member based on my profit share.
Yes, generally. Same
Good.
example.
Hmm.
If that $100 Hay loan was non-recourse and profit shares were 50-50, both the GP and the LP would each add 50K to their outside basis. For LLCs specifically, members are generally treated like limited partners for recourse debt, no basis unless guaranteed, but non-recourse debt, allocated based on profit shares, just like in a partnership.
What about a loan from a partner to the partnership? How's that handled?
That's treated as recourse debt, but it's allocated entirely back to the lending partner.
Yeah.
So if I lend the partnership $50,000, that $50,000 increases my outside basis and nobody else's.
Interesting. Why only allocate it back to the lender?
Because economically, that lending partner bears the full risk of loss for that specific debt. They are the one who won't get paid back if the partnership fails. So the basis increase reflecting that risk goes entirely to them.
Okay, so recourse debt goes to personally liable partners, GPs, guarantors.
Hmm.
Non-recourse goes to all partners based on profit share, and partner loans go back to the lending partner. That's critical for figuring out basis. And basis isn't static, right? It goes up and down after formation.
Absolutely. It's constantly changing. Think of it as your running scorecard with the partnership. Your basis increases when you make additional contributions, cash or property basis. When the partnership allocates taxable income or gains to you, even if you don't get cash, also tax-exempt income increases basis. And importantly, when your share of partnership debt goes up,
And decreases.
basis decreases when you receive distributions, cash or the partnership's basis in distributed property, when the partnership allocates losses or deductions to you, also for certain non-deductible expenses, and logically when your share of partnership debt goes down.
Makes sense. Income up, losses and distributions down. Now, you mentioned built-in gain or loss earlier when we talked about property contributions. Can we circle back to that? How exactly does that work when the partnership eventually sells that property?
Right. Built-in gain or loss. And this is crucial for fairness. If you contribute property where the fair market value, FMV, is different from your adjusted basis at the time of contribution, that difference is the built-in gain or loss. The rule is simple but powerful. When the partnership later sells that specific property, the built-in gain or loss amount must be allocated back solely to you, the contributing partner.
Only to the contributor.
Yes, that pre-contribution difference part. Any gain or loss that happened after the contribution date. That part gets allocated among all the partners based on their normal profit-loss sharing ratios. Example 4 lays this out perfectly. Joan contributes property. $100 pay basis, $150K FMV. That's a $50 K built-in gain. Later it sells for $180K. Total gain is $80K. $180K sale, $100 K basis. The first $50 of that gain, the built-in gain, goes only to Joan. The remaining $30 K gain, $80K total, $50 K built-in, is a post-contribution gain. If Joan is a 20% partner, she gets $6K of that $30K, 20%. So Joan's total gain is $50K plus $6K equals $56K. The other partner is only sharing that $30 K post-contribution piece. It ensures the tax follows the economics of who brought in the appreciation or depreciation.
That's a really clever rule. It prevents shifting tax burdens unfairly. And the partnership's inside basis in that property. Just to confirm, it starts as the contributor's basis.
Generally, yes. It's a carryover basis. The partnership steps into the contributor's shoes regarding basis. So in example 5, Jeff contributes a building with a $100 K basis. The partnership's inside basis is $100 K. The only main exception is if the contributor recognized gain on contribution, like from excess liabilities, then the partnership adds that recognized gain to its inside basis.
Okay, now basis seems critical for another big reason. Deducting losses, right? You mentioned it's the first hurdle.
Exactly. Basis is hurdle number 1. Your ability to deduct your share of partnership losses is limited, potentially by up to 4 separate hurdles. Basis is the first.
4 hurdles. Okay, what's hurdle 1, the basis limitation?
Tax basis limitation. You simply cannot deduct losses that exceed your tax basis in your partnership interest, calculated at the end of the partnership's year. If your allocated loss is, say, $10,000, but your basis is only $7,000, you can only deduct $7,000 this year.
What happens to the extra $3,000 loss?
It's suspended, carried forward indefinitely. You can use it in a future year if and only if you get more basis from income, contributions, or more debt allocation. Example 6 shows this. $3 K basis, $4 K loss allocated. Deduct $3, suspend $1.
Okay, hurdle 1, basis limit. What's hurdle 2?
Hurdle 2 is the at-risk limitation. This one says you can only deduct losses up to the amount you are economically at risk of losing. Your at-risk amount is usually similar to your tax basis, but critically, it often excludes certain non-recourse debt, the kind where you have no personal liability and it's not qualified non-recourse financing, or QNF.
Qualified non-recourse financing, what's that typically?
Think typical commercial mortgages on real estate from unrelated banks. That kind of non-recourse debt does usually count towards your at-risk amount. But other types of non-recourse debt might increase your tax basis, but not your at-risk amount. So a loss has to pass the basis test first. Then the amount that gets past basis has to pass the at-risk test. If it fails the at-risk test, the excess loss is suspended separately under the at-risk rules.
Can you give an example of how basis and at-risk might differ?
Sure. Example 7 highlights how debt type affects this. A general partner might have both tax basis and at-risk basis from recourse debt. A limited partner might get tax basis from non-recourse debt, but might not get at-risk basis from it unless it's QNF. Example 8 walks through it numerically. Rachel, in an LLC, has a $35K loss allocated. Her tax basis is $33K. Her at-risk basis is only $25K. First hurdle, basis. Can she deduct $35K? No, limited to $33K basis. So $2K loss is suspended due to basis. Second hurdle, at risk. Can she deduct the remaining $33K base? No, limited to her $25K at-risk amount. So she deducts $25Ks this year. The difference, $8K, $33K minus $25K, is suspended due to the at-risk rules. End result, $25K deductible now, $2K suspended by basis, $8K suspended by at-risk.
Wow, okay. So you track basis suspended losses and at-risk suspended losses separately. What are the other two hurdles? Source just mentioned them.
Yeah, the source mentions passive activity loss, PAL rules, and the excess business loss limitation. These are further tests that can limit loss deductions even if you clear basis and at-risk, but the material here focuses on the first two.
Got it. Basis and at-risk are the big partnership-specific ones here. What happens to those suspended losses, the ones waiting for more basis or at-risk amount, if I sell my partnership interest before I can use them? Are they just gone?
It depends on why they were suspended. That loss carry-forward summary table is key here. Losses suspended due to lack of tax basis, those are generally lost forever if you dispose of your interest, no future benefit. But losses suspended due to the at-risk rules, those get slightly better treatment. When you sell your interest, you can use those suspended at-risk losses to offset any gain you recognize on the sale, so they can reduce your tax on disposition, even if you couldn't deduct them earlier against other income.
Okay, that's a subtle but important difference in how those suspended losses are treated at the end. Good to know. All right, shifting gears a bit, let's talk about the partnership's ongoing operations and transactions between a partner and the partnership itself.
Right, beyond just contributions and distributions.
Who makes the big tax decisions? Like accounting method, cash, or accrual, depreciation, tax year. Does each partner choose, or is it the partnership?
It's the partnership that makes most of these key tax elections. It decides as an entity. The source lists examples, accounting method, depreciation, tax year, usually calendar, but options exist, choosing installment sale treatment, and the Section 754 election.
Section 754, what's that? The source mentioned it but didn't explain.
Right, it wasn't detailed here, but briefly, a Section 754 election allows the partnership to adjust the inside basis of its assets when a partnership interest is sold or transferred, or when certain distributions occur. It helps align inside basis with the outside basis of the partners involved. It's an entity-level choice. The point is, the partnership acts as one for these big tax decisions.
Okay, partnership makes the call. What if a partner interacts with the partnership not as a partner, but more like an outsider, like selling goods to the partnership or providing specific services for a fee?
Generally, if a partner is acting in a capacity other than as a partner, the transaction is treated as if it happened between the partnership and an unrelated third party. Normal tax rules apply.
Okay, treated as unrelated. But I bet there are exceptions, especially with related parties.
Exactly. There are specific rules when the partner and partnership are considered related parties. The main definition here involves a controlling partner, someone owning more than 50% of capital or profits, and the partnership.
Over 50% is the trigger. What are the special rules then?
Two big ones to watch out for. First, related party losses. If a controlling partner sells property to the partnership at a loss, that loss is disallowed. The partner can't deduct it. It's meant to stop people from creating artificial tax losses within a controlled group.
Loss disallowed. Makes sense. What's the second rule?
Second, related party gains. If a controlling partner sells property to the partnership at a gain, that gain might be recharacterized from capital gain to ordinary income. This happens if the property sold is not a capital asset in the hands of the partnership, the buyer.
So, converting capital gain to ordinary income. Why?
To prevent, say, selling depreciable business property or inventory, to your controlled partnership to get a low tax capital gain when the partnership will just continue using it or selling it in a way that generates ordinary income for them. It forces the gain character to match the buyer's use if it's ordinary income type property for them.
Got it. So be careful with sales between controlling partners and partnerships. Losses might disappear, and capital gains might turn into ordinary income. What about guaranteed payments? I hear that term a lot. Is it basically like a salary paid to a partner?
Yes, that's a good way to think about it. Guaranteed payments are payments made to a partner for services or for the use of their capital, and the key is they are paid regardless of the partnership's income or loss for the year. It's a fixed amount.
Fixed amount, like a salary? How's it treated for tax?
For the partnership, it's generally treated as a deductible expense, reducing the partnership's ordinary business income that flows through to all partners. For the partner receiving it, it's taxable ordinary income. Example 9 shows this: $20 K guaranteed payment to James. Partnership income was $100. Deduct the 20 count, leaves $80 ordinary income. James, 50% partner, gets his $40 share of the $80 plus the $20 K guaranteed payment, totaling $60 K ordinary income.
Okay. Deductible to the partnership, ordinary income to the partner. Anything else about them?
Yes, 2 important points. Guaranteed payments for services are generally subject to self-employment tax for the receiving partner. And interestingly, they are not considered qualified business income, QBI, for the Section 199A deduction.
No QBI deduction on guaranteed payments. That's a key planning point. What about payments to retiring partners?
If a retired partner gets payments that aren't specifically for liquidating their capital interest, meaning they're more like pension or retirement benefit payments, those are generally ordinary income to the retiree and deductible by the partnership.
Okay, deductible retirement payments. Good to know. So we've covered getting in, basis, operations, partner transactions. Finally, let's talk about getting value out. Distributions. How are these taxed?
This is another area where partnerships differ significantly from C-Corp. Generally, non-liquidating distributions, meaning distributions made while the partner continues to be a partner, are non-taxable.
Non-taxable, both cash and property.
Generally, yes, to both the partner and the partnership. The idea is that it's just a return of your previously taxed investment, your basis. It's not generating new income.
Okay, usually tax-free. But it must reduce my basis, right? Since I'm getting my investment back.
Absolutely. Distributions reduce your outside basis. There's a specific order if you get multiple things. Basis is reduced first by cash distributed, then by the partnership's adjusted basis, NBV, in any property distributed.
Reduce basis, cash first, then property basis. What if I get cash, and the amount of cash is more than my basis before the distribution? Does basis go negative then?
No. Basis cannot go below zero. This is the main exception where a distribution becomes taxable. If the cash distributed exceeds your pre-distribution basis, that excess cash is treated as taxable capital gain.
Excess cash is capital gain. Basis goes to zero.
Exactly. Your basis is reduced to zero by the cash, and the amount of cash over your original basis is taxed as capital gain. Example 10 illustrates the basis reduction part, though the cash, $24K there, didn't exceed the starting basis, $30, so no gain was triggered by cash in that specific example.
Right. In example 10, Alinto had $30 K basis, got $24K cash, so his basis dropped to $6K, $30K, $24K. Then he got land the partnership had a $9 chip basis in. His remaining partnership basis, six-tail, is less than the land's basis, $9K. What happens then?
That's where the rule preventing negative basis kicks in again, but this time on the property side. Since his remaining partnership basis is only $6K, his basis in the land he receives is limited to that $6K. He can't take a $9 basis in the land if it would drive his partnership basis below zero. So he takes the land with a $6K basis. His partnership basis is then reduced by that $6K, taking it down to zero. He ends up with a basis in the land that's lower than the partnership's basis was.
Okay, so the property's basis gets stepped down to match my remaining partnership basis. What if it's even more complicated? Say I get cash and inventory and land, and my basis isn't enough to cover the partnership's basis in both the inventory and the land. How do I allocate my limited basis?
That's example 11. This requires a specific allocation order when your remaining basis after cash isn't enough for all the distributed properties. The goal is still to get your partnership basis to zero, allocating it out to the assets. The order is: Step 1, reduce basis by cash received, always first. Step 2, allocate your remaining basis to any hot assets distributed, up to the partnership's basis in them. Hot assets are things like inventory and unrealized receivable stuff that generates ordinary income. If you don't have enough basis for all the hot assets, you allocate proportionally among them. Step 3, Allocate any basis left after cash and hot assets to other property distributed, like land, buildings. If you run out of basis here, this other property takes a basis equal to whatever partnership basis you had left.
Let's walk through example 11 with that order. Alinto, 30 toggle basis. Gets 24K cash, basis drops to 6K. Then gets inventory, hot asset, with $5K partnership basis. He has 6K left, which is enough, so inventory gets $5 basis. His partnership basis drops to 1K, 6K, 5K. Then gets land, other property, with $9K partnership basis. He only has $1 basis left, so the land's basis is limited to 1KK. His partnership basis drops to 0.
All right.
Perfectly explained. He walks away with the cash, inventory with a $5K basis, and land with only a $1K basis. His partnership basis is 0. It's a strict ordering rule to allocate that limited basis.
Wow, that's quite a process, but it follows a logic to soak up the basis without going negative. We've covered a ton today, really a deep dive into these advanced partnership tax areas, from formation, the taxability of contributions, services, the absolute centrality of basis, both outside and inside, how debt weaves through it all, the limits on deducting losses, those tricky related party rules, and finally, how distributions work, generally tax-free but with crucial basis adjustments and potential gain triggers. Definitely. We saw how basis is just, well, it's everything. It limits losses, dictates gain on distributions. And those nuances, capital versus profits interest, recourse versus non-recourse debt, they really show how different partnership tax is from, say, C Corp.
It really makes you appreciate why partners need good tax advice. So, pulling all this together, what's a final thought for our listeners to chew on after exploring all this?
Well, it raises a really practical question. Tying basis and distributions together. We said non-liquidating distributions are generally tax-free up to basis, right? And we saw that basis includes your share of partnership debt. So, does that mean partnerships can effectively let partners take out cash tax-free by just borrowing more money at the partnership level, which increases partner basis? And if people do that, what are the catches? What are the risks? Or maybe reporting things to watch out for? It's a common strategy, leveraging debt for distributions, but understanding all these rules we talked about, basis, debt allocation, potential gain triggers, is absolutely key to doing it right.
That's a great point to ponder, using debt to fund tax-free distributions. Lots of potential, but lots to consider. Thanks for joining us on this deep dive into advanced partnership tax.